Welcome, friends, to our weekly High Rock video. If you are watching for the first time and are interested in learning more about High Rock, please feel free to check out our website at www.highrockcapital.ca. I'm Scott Tomlinson, and with me is my partner and colleague and the founder of High Rock, Paul Tepsich. And today we are going to talk about our three asset models and any updates or developments in and around our tactical strategies and what we see happening in the global economy, financial markets, and other issues pertinent to the world of wealth management. Well, as far as our global equity model, we've seen about half of S&P 500 companies reporting for their first quarter earnings, and they've come out in a little above expectations. However, the market at this particular point is more focused on what will happen farther down the road in 2019. And as we mentioned last week, earnings for 2019 are not anticipating to show much growth. So investors are kind of rethinking their desire for global equities, and this has allowed stocks to retreat into prices that represent a little bit better value. In fact, money has been flowing out of equity mutual funds and ETFs over the course of the last 3 months, and as you recall, February was a pretty volatile month, and that outflow of money from U.S. equities has continued through March and April as well. So we are seeing definitely less aggressive buying of stocks, and stocks tend to be trading in a range bound by what we'll call selling resistance to prices moving higher on the upside, and buying support when prices get to a certain level. And in this case, that support has been represented by the 200-day moving average for the S&P 500. So it's kind of held stocks in place. But we're still in this range, and looking, traders and investors are looking for what the next direction will be. Historically, when these resistance points or support points are broken either to the upside or to the downside, you'll tend to get follow-through buying and selling on the other side of those. Again, we're kind of in the middle of that range, so still waiting to see what happens next.
And Scott, maybe one thing we could add there too, which we haven't shown a chart or looked at in quite a while with our clients, is margin debt, which is the amount of money investors borrow from investment dealers and banks to invest in stocks and bonds, is at an all-time record high as well, and still at that record high. So as you said, if it does start selling off through that buying support or the lower lines, it could in fact snowball more, and I think that's a real risk right now, especially with short-term interest rates having climbed a fair bit here.
And that plays to a degree into our strategy. We've remained relatively underweight global equities, waiting for better value. So if that were to occur, and those highly leveraged positions start to need to take sales to cover some of the lower prices that are assigned to those stocks that they own, then for us that's a positive thing. So that's been the position that we've been taking. As for the U.S. economy, we got data on the U.S. economy last week. The first quarter of the year showed a slightly less strong, on an annualized basis, U.S. economy with GDP growth of 2.3%. The estimate was somewhere between 1.8 and 2%. So a little more than expected, but still less than the previous 3 quarters. A lot of that has to do with the fact that the consumer just wasn't involved to the same degree that it has been in the economy. And there could be a couple of reasons for that. Obviously, one of them certainly could be that higher interest rates are impacting an already overburdened household from a debt perspective. So again, we'll watch and see how developments move with the U.S. economy, but at this particular point in time, again, we are looking at those indicators like the bond market that give us some forward-looking clues. And we talk about this on a regular basis, but once again, the U.S. yield curve has flattened to its lowest level, which means that the spread between the 30-year bonds and 2-year bond yields have narrowed into the narrowest they've been since 2013. And Paul, we can look at this in another way. If we look at this yield curve, we look at the green line here, which is the current yield curve. We can see how it's changed since that peak that we saw in the previous chart from 2013. So we've seen short-term rates have gone up quite significantly, 150 basis points or thereabouts. But at the very far end, and the maturity spectrum being along the bottom axis, you can see that out in the 30 years, we've actually seen yields come down. And then as we look forward, we see expectations that the Fed may raise rates almost 3 or 4 more times, or at least 3 more times this year. And then what that might impact, how that might impact the longer end of the curve, continuing to push the momentum lower, and that's where you get that flattening of the yield curve. So here's just an example of where a flat yield curve, or what a flat yield curve might look like. And as we've talked about before, after you get this flattening of the yield curve, or even inversion of the yield curve, the next situation that occurs is recession. So again, these are what we're looking at, but just a different way of looking at that. Paul, any comments here?
Well, yeah, be careful when people talk about interest rates going up. That's an awfully long curve from overnight out to 30 years. So it depends which, and we position ourselves very strategically and tactically on the yield curve. So I can tell all of our clients and listeners that since day one, which has been over 3 years ago, in our private client division, we have been more heavily weighted in 30-year Government of Canada bonds, as well as 30-year investment-grade corporate bonds, which trade with a very high correlation to 30-year Government of Canada bonds. So, in fact, that's been very protective and somewhat beneficial to us over the last number of years.
So let's look at the Canadian situation. So there's the spread between the 30 years and the 2 years. Again, we're almost at the low. We're just a little off the lows, about 5 basis points off the lows. But there's the Canadian curve. And again, interestingly, Canadian yields in the short end from 2013 actually moved lower first before they moved higher. But the 30 years, as you've just been saying, Paul, that 30-year yield has come down. And as the yield comes down, of course, that's positive for the prices on the bonds. And if we have a longer maturity spectrum in our Canadian, especially in our Canadian government bonds, but also in our investment grade bonds, that helps to improve the value of the holdings that we have in that particular model, right?
Absolutely.
Yeah. And now that we're looking at the yield curve, let's look at one more yield curve, because this. Whoops, sorry. There's. Let's go back just 1 second then before we go to the next level. If the Bank of Canada were to raise rates, as some have suggested they may, by another couple of about a half percent or a couple of 0.25% moves, then we may again also see further flattening of the yield curve, and similar to what's happening in the U.S. Again, we could look to see potential for recession in Canada. Now,
the last thing to mention about the yield curve, Scott, and both the Fed and the central bank Bank of Canada hiking up short-term rates is, people need to remember, both the Fed, the bank, and all these central banks around the world, they really only affect the overnight lending rate, and they effectively peg both what banks lend to each other and what the central bank will lend to another bank, a commercial bank. So the shape of the curve tells us something, but consumers largely borrow inside of 5 years and inside the curve. And a lot of that is car loans, car leases, mortgages, of course, lines of credit, etc. But corporations largely borrow further out the curve some in the 5-year, but a lot in the 10-year and out to the 30-year part of the market. And especially what's really important out here is a lot of investment grade, big investment grade type issuers, you can think like Apple, et cetera, have been borrowing heavily in the investment grade corporate bond market, way out the curve in the 30-year part to do stock buybacks. So they've had a pretty decent call, and they're not really at risk at this stage with the curve moving their way. So stock buybacks are somewhat supported by those issuers who have been issuing out in the long end. It's the consumer in the front part of the curve that will have the worst effect of central banks hiking up the overnight lending rate.
And while you're on that point, let's just look here. Here's the Royal Bank of Canada's bond curve. So in essence, the Royal Bank borrows along this curve, as you were saying, Paul, as a corporate borrower might borrow, right?
Yeah, exactly. This is their, in fact, their senior unsecured bond curve. Now it doesn't have. I can pull it up, not right now, but the debt distributions chart, which would tell us how much they borrow at what tenor of the curve, what part of the yield curve, whether they borrow the most at 3-year, 5-year, 10-year, 30-year. But nonetheless, this is where they borrow at in the senior unsecured bond market.
And where they lend is a bit of a different story too, right? Because when you look at what's happened just last week in mortgage rates in the 5-year, so the consumer is paying somewhere in the vicinity of 5.25% to 5.5% in the 5-year fixed mortgage now, and in the front end, of course, they're paying prime. But you can look and see. Here's where the banks certainly are able to make a fair bit of money off the consumer, right, with the spreads over which they borrow versus where they lend.
Yeah, that's substantial margin. And there's only 6 of them in the country.
That's why Canadian banks continue to do reasonably well, I guess, huh?
Yep.
And the consumer is certainly at a point where they've been borrowing fairly heavily, both in Canada and in the U.S. at record levels, for that matter. So as their rates rise, as I was mentioning before, as far as the economy is concerned, that tends to take away from the economy because they have to spend more money servicing their debt. All right, well, that's it for us for this week. As per usual, please, if you will, send us your thoughts or any ideas of topics that you would like us to discuss on this call in our future episodes. But until next time, this is Scott Tomlinson, and on behalf of Paul and Bianca, I wish you all a great week.